Have you ever been sitting on a $300 profit watching it tick down to $200, $100, zero, and then flip into losses, all before you even had a chance to react? That gut-wrenching moment when you think you've actually nailed the trade, only to have your gains vanish. I think we've all had that experience at one point. Today, I will expose exactly why it happens and how you can stop it. Too often, your stops become bait for banks, unloading block orders, algorithmic bots hunting for micro pips, and crowded retail stops. A single Fed whisper or a surprise NFP print can spark a breakout that's really a stop hunt in disguise. You enter on a promise, a big move, only to discover that you're trading against the smartest players in the room, and you're falling for those trading traps. That's not bad luck. That's predictable market manipulation, and it costs you real money. So in this video, I'm walking you through the exact signals pros use to avoid these landmines, starting with the 3 biggest setups that can turn your winners into losers. And then 4 advanced checks that can help you really turn things around. If you haven't done so yet though, please do me a favor, hit the like and subscribe button so that you never miss another breakdown like this. I want to start with pump and dump schemes. Ever seen a tiny penny stock or random crypto shoot up 80% in minutes, but there's no real news behind the move? We even see this in currencies, huge jumps for no reason. That's the type of hype machine at work. Influencers or traders in Discord, Twitter, Reddit, they blast their buy signals, luring retail traders in, and the promoters sell into that frenzy. Imagine a penny stock jumps from 50 cents to $1.20 in an hour without any real press release or sector news. Volume surges tenfold and yet no analyst explanation surfaces. You're struggling to find an explanation. That should be your red flag. When the hype crowd crushes to buy, the insiders quietly unload and price ends up collapsing back below 50 cents and you turn to losses. To avoid this, always cross-check a sudden rally against credible news sources or filings to see if there's any official press release or news report. If there isn't, pause. Compare the real volume against price to spot the weak moves and verify the sources beyond the rumor mill so you don't become the last buyer on a ride down. Another common trap is stop-loss hunting. This happens when the big players push the price into obvious stop clusters, which often sit below well-seen support lines or above round number resistance. Once those stops trigger, you may see price reverse quickly, leading stop hunters with your unwanted fills. A really good example would be Eurodollar 110. Retail traders oftentimes will place their stops just under that level, 109.95. And, you can oftentimes see a large sell order push down the price to that level, clear those stops, and then Eurodollar jumps back up above 110.10 within minutes. To avoid price action like this, you want to place your stops a few pips beyond the crowd, well under the swing low, rather than the obvious round number. That extra buffer can keep you from being prematurely stopped out. Fake breakouts also happens a lot when price pops above a key level, perhaps a previous high or a trend line with low volume, and then it collapses immediately as traders jump in on the breakout, only to see it reverse and trap them on the wrong side. Now, the best way to avoid this is to wait for a confirmed close and a retest before you commit to the trade. If you want to go deeper, these are 4 drills that I want you to add to your routine every time you see a potential trap. Number 1, study market behavior and look for volume price divergences because genuine moves explode on heavy volume. Light volume breakouts, maybe you want to sit that one out. Second, I want you to look at candlestick shadows. Long wicks mean rejection. If you see a big wick on a candle breakout, that could be a warning to you. Third, look for order book levels. Watch level 2 for orders that vanish as price approaches, which is classic spoofing. Fourth, look for liquidity grabs, which are sudden, isolated spikes, often 1 or 2 candles that can mark stop hunts or erroneous orders. True moves actually build momentum, so let these fat finger spikes settle before jumping back in. Also, I want you to be wary of market manipulation. Choose deep liquidity instruments to minimize slippage. Stay away from those thinly traded markets where a single large order can move the price dramatically. Ultimately, developing a solid trading plan really is your best line of defense. Spell it out. What is your entry criteria? Do you buy a moving average crosses? Do you trade Elliott wave? What is your exit criteria? What is your position sizing? Don't be lured into sudden pops and drops by sticking to your trading rules. Also, protect your capital with logical stops placed beyond technical points, not at the round numbers, the obvious levels. Control your trading size to avoid emotional pain and let your trades breathe, and avoid those correlated trades by diversifying. Don't fall prey to FOMO, the fear of missing out. Resist chasing parabolic rallies. Wait for confirmation of price, volume, and time. And please, please, please don't revenge trade. After a loss, your urge to get it back can cloud your judgment. Instead, I want you to step away, clear your head, and return objectively. You want to avoid anchoring or herd mentality. Don't fixate on yesterday's high or follow the crowd without question. Lastly, stay disciplined during volatility. When markets roar, ignore the intraday noise and stick to your chosen time frame and strategy. And try to limit leverage, because when you have high margin, you can turn a minor reverse move into a completely blown account. And scale out profits. Lock in those gains incrementally. Take half off of your first target, move your stop to break even, then let the rest run. That's how I locked in gains on some of my best trades. So if you found this breakdown valuable, smash that like button and subscribe for more pro-level trading insights. If you've experienced things like this, type the word stop. If you're ready to take your skills to the next level, grab our free day trading course by joining our free trading community. The link plus recommended prop firms and broker partners is in the description below. I'll see you on the side, and here's to making every trade count and avoiding those trading traps.